Okay, so let's take a look at these charts here and get an idea of how this was structured going into the morning, how this worked. So the first thing, of course, is always what on earth were we looking for into yesterday's close? If you remember, there were some troubles with the way that it's set up that I had problems with. I thought the institutions were going to need some convincing. The bulls had some problems, and I think a lot of people just walk away when things don't work. So we got to the point where we were looking for trailblazers. Trailblazers are people who are trying to catch in the turning points, not the inflection points, the actual lows and highs. And trailblazers have higher risk, but they tend to have higher reward. They're hard to trade with. And I talked about this last night, and I really hope that you took that into consideration and that it was useful. If you look at the overnight market, there was a lot of up and down and pushing some new lows and things, and you really needed to keep that in mind. This is just how trailblazer markets work. They're tough. So into this morning, looking for trailblazers, we needed to rebuild the market. The very first thing that happened was decay moved down, and we had some volume right here, and there was sort of a problem with it. You know, things just moved straight down. And you can see that tension right there, it moved down with it. Basically, right off the open, the bulls, nothing. There was just nothing. They didn't show up. They didn't hit. Tension curled down. Nothing. No bulls. And that isn't necessarily unexpected. If you remember yesterday, the bulls were like, forget this market. I don't want to play. You guys are just going to whatever happened and let the bears drive it down into a range. I don't want to play with this. So nothing happens off the open. I'm not surprised. That was what we were looking for in yesterday's close. Now, the next event that happens, you could see decay poked its head up, gave us positive energy that people were able to see. There are the trapped orders, and the bears didn't hit the liquidity. They were offered a bunch of buy orders that they could take and match their sell orders with, so they didn't pop the open interest on accident, and nothing. In fact, we see almost immediately tension starts to rise. This is a big problem. There's a no-show, and then there's a no-show, and then this pops up, and I think instantly liquidates those bearish players should there have been any. If there were ghost or shadow traders there, those shadow traders got wrecked. So what does this mean? Well, it's not as crazy as you think. Not showing up right here, I think, was a big deal for the bears. We had it was like, I think 65% into the close yesterday, if I'm not mistaken, pushing up. It was a lot of upside tension. The market didn't get this, right? The bears don't show up. The controlling party steps aside. Only a controlling party can step aside, and that sets off elasticity. Why is it elasticity? Well, since you're in control, you can allow the market to move up, and it's sort of like an elastic rubber band. You let them move it up so that you can bring it back down. That's what this was. They stepped aside to let the market get elastic. And we saw the immediate, there was some enthusiasm there. That enthusiasm led to the liquidation of the bears. We were expecting this kind of junk today. And not that it was junk, this is actually pretty typical. This is the thing that happens all the time. This is the rule, not the exception. Well, right after that happens, we can mark out where that position turned upside down, right here. And I don't think you should be surprised that that's the support for the market. I'll color it green because it's going to be supportive, and you can see right here that that moment when the market got elastic is exactly where the market came back down to, tested it up, and we haven't come back since. That is not surprising. This shouldn't surprise anyone. The market gets elastic, and the objective here is simple. Let me lay it out so you understand what to look for. In an elastic market, just going to say L. elastic. The first thing is you need a controlling party. You don't get elasticity without a controlling party. We know the bears are in control. We saw them yesterday here. They popped in and they were able to come and control the market. They got everything they wanted. So we have a controlling party. The second thing is we need that controlling party, essentially the tension, to get high. It's just too much tension to deal with. And getting this down so far here, they needed that, before we got that to continue, they needed to burn some of that off. And that necessity is what leads to elasticity. Then you see the controlling party. So we get through 1, we get through 2. The third step is to see them step aside. Stepping aside is the permission given by the controlling party for the counterparty to cause the burn. Why would they do that? Well, think about it. If you have complete control over the market and you if you're a bear, you have complete control over the market and you let the bulls come in and drive this up and then you pick it up here and pump it again the next day, that's a win-win. The bulls get to make some money on the counter side and you get better prices to retrade. There's no loser here, just everyone uninformed. The bulls were given the okay to come in, to drive tension back up, and to financially take advantage, to take advantage of the price move in an attempt to get tension to cool off so that the bears could do this. Now, this is from the bears' perspective, of course. The bears are thinking, okay, we'll let those little silly bulls come in, those silly, stupid bulls who, that's their attitude, these little pathetic things. We'll let them come in and we'll let them have a little money and we'll consider that a payment for giving us better prices. That's what the bears' mentality is. That's always the mentality of the controlling party during elasticity. Let those silly counter guys, whatever, I have a terrible accent. Let them come in. We'll let them have the money and blah, blah, blah. That's what they're thinking. So the next step here, after you get the counterparty, so we're at 1, 2, 3, the next step is the counterparty. Now this is where things get a little tougher. So you don't just hand the market over to no one. You hand the market over to counterparty. And the counterparty was pretty straightforward here. It was this group. I have to remove that. There's a pivot. There's a pivot. Pick one. It doesn't matter to me. Pick one. They both got hit roughly the same time. We get a move down, a move up, and then a second move down. This was the wide. This was the short. So in the wide short, you have a wide test. It's a wide amount of space. And then you have a short amount of time. So a wide test and then a short amount of time. And so let's get a little closer here because I want to describe just exactly how this worked. It was pretty straightforward. Do you see right there? So we got our wide test and then it took a minute and then the short amount of time test. Here's our trapped orders. And then here's the new highs. And to get a decay retest, you need the decay retest. So 2 pivots that are significant. I take significant pivots, not just every little turning point. Then you need trapped orders, which you can see here. And then you need new extremes, which is these down here. You see, this is new highs being made in the market. It means that the whole market was lurching in that direction. So not only did we get the structure, we got the volume, and we got a response from the market. So I track these that way. And the way this works is pretty interesting. Let's get a little closer here so I can show you. I mean, I think it was easy to see, but basically what happens is with a decay retest, you get a little different set of rules than liquidity. Decay retest, I also call a risk reduction. And the point here is to give you a way to reduce your risk with a high probability, that price pops up. So you expect a thing where you get all the stuff that you want, you get some new highs, and then it pops up. And so you're basically saying, I would like to increase the probabilities that I can catch 2 or 3 points to cut down on my risk of a position. But, and there's a huge but here, everyone knows your stops are just below because you're reducing your risk. You're scared. So one way the market loves to create liquidity is to hit your stops. It's called open interest theft. You do the work, sign and write the contracts with each other, create all those binding contracts, pop the open interest, institution sits back. They say, great, you built it. Now give it to me because I don't want to get in the market without and pop the open interest. Okay, go pee-pee, go to the bathroom. You can do it. My 5-year-old's learning to go to the bathroom. Well, telling me he has to go to the bathroom. Okay, so what happens here is that they tried to reduce that risk. That's what they wanted. And the market came in here and hit their stops and stole the open interest. This is standard liquidity. You should all know this. So we get the risk reduction. The stops are always just below, and it happens to correlate with right here. There's some support here. Why is it supportive? Don't you dare tell me that a lot of volume supports markets. That's stupid and ignorant. Losers support the market. This is a bearish position. There are people who did not liquidate. Of course, they're dumb. The market doesn't want to let them out. They're debit accounts, meaning that when they put their money into their trading account, they're depositing money into their trading account. It's not credit. Your broker isn't treating those accounts like we're going to credit them with money. No, they're considering all their money as deposited and a huge loss. This was a deposit. They don't want to let it go. That's why it's supportive. It's not because there was volume there. That's silly. That's a silly idea. That's silly. Volume means nothing. So in this instance, there were a bunch of losers there, enough that we know that they were fairly informed because of their placement, because they were tracking institutional money. We know they're informed, so we know there's good money there. Don't let them out. That's the philosophy. So we're able to stop out this position and collect some liquidity for the bulls. And this is legitimate bullish liquidity. You can see the trapped orders right there. The bars are green. This isn't abstract. So if this seems abstract to you, like I'm sort of just grasping at straws, this is absolutely not abstract. It's a lack of understanding on your part, not a lack of structure in this method. This is pretty straightforward. We get a decay retest with stops just below. They get hit. There's the trapped orders. We have people, shadow traders, who messed up and are stuck upside down and holding on with that wonderful strong emotion, hope, which eats you for breakfast. And so we've got somebody to pay. We have our bag holder. We all need those. We have liquidity. That's good. We need to be able to find a spot for institutional money to come in without spiking open interest. So you got to figure out how they do that. And they did that effectively here. It was a little less traditional because they were using open interest theft versus the other way that we typically measure with the zero tests. Everything's in place. So the next thing to do is say we have all the pieces. Where do you go? Where do the bulls want this to go? They're in the market. They have position. Did they impact? Yeah. I mean, that looks like impact to me. So the bulls have accepted the challenge of elasticity. The bulls are in the market. The bulls they're not only in the market, they've been approved by the bears to get this up as high as they can before the bears say, hey, okay, we're the controlling party. We're going to take you down. That's how this works. Okay, so as the market moves up, where do they want to go? Well, the first thing maybe to end a couple of these guys here, if anyone's holding on, which they shouldn't be, I assume their stops are here, is where that they would unwind their position. Let's go ahead and mark that. I know, you can already see what happens, but we're going to go through it anyway. Why would I choose that? Because it's obvious to me. I mean, I think if you're going to like this is obviously where you're going to put your stops. And the next group I still have marked from yesterday's analysis, which is these guys here, and their stops are up here. There's a big fat pot, big old slice of pie right up there. Big old juicy piece of pie. Are we going to go for it? Would you? Of course you are. Of course, that's what the bulls want. The bulls wanted this from yesterday. It's just they were irritated. And we got all the structure we needed. We got the pieces we wanted. We got the elasticity to set up. We got the bulls coming in and they got some liquidity. So they were able to position properly. They have places to go. They got people to pay. This is not abstract. In my opinion, this actually gave us a lot more structure than I was thinking we were going to get today. I was concerned that the bulls were going to be lackadaisical, lazy, less interested, but they weren't. They came right in, picked up liquidity, and took off with the elasticity. So that was their initial move, in my opinion. It's just my opinion. If you were able to pick up on this as liquidity, and you saw it move forward, and you saw you had support here, you're done. Get out, take the money, stop being so greedy. Now, if you saw this and you mixed it with yesterday's analysis, you may have said, hey, we might be able to get this up to here. And you knew about probably these guys. Maybe you could have held on to this, but again, take the money, just take it. I know there's another leg here, but honestly, catching the meat and potatoes of moves is significantly easier to do over a long period of time than trying to catch trends. I'm not saying don't. Okay, if you want to go for trend trading, that's a good idea. And the reason for that is that it enables you to catch larger pots of money, and that's really important. But if you're not super familiar with how to actually read a market like this, you should go for impulse moves. It's the best way to be consistent. It's the best way to actually grow your account. Once you get good at this and you can start to read into the fact that this market wants to go up here, then you hop in here, you take some profits, and you add. You should never walk away with a break even if you're going to try and position into this and catch a second leg. What does that mean? Well, let's do a little bit of math, and I want you to understand this. If you add with 2 contracts here and you take one off the table, so you minus 1 here, you're left with 1 position, which means that any move back here, if you reloaded a position, you're going to get a 50% loss in this position if you add, because it'll bring up your position. If you add 3 here and you take 1 off the table, then when you put here, you're going to see a 1/3 loss. And you start to see the idea here is that your initial position needs to have enough size that as you add into it, you don't significantly lose your initial position. Otherwise, a move down like this could have very well hit a break even on anyone who was adding a position here. This is the only reason Fibonacci's work. There's no other reason for it. It's because people like to add to their winners and to their losers, and then they dump when they get scared because they don't know what they're doing. So what you should do is add here, let's say you do 4, and then you take, say, 1 off the table here to make sure you walk away with a little, and then when it leans back, look for worst, I don't know what's with my spelling, case scenario. Look for that, and then add there. Don't take the best signal. Don't forget about teeth. You add when the people trying to do what you're doing are getting out. So look for, some sort of buy signal maybe, and then look for that signal to fail and add on the failure. That's how you properly add to a winner. You don't add to a winner at the next buy signal. You add to a winner at the next buy signal's failure. And make sure that your initial position has enough size that you can take out a position and take a little money home and then add to it properly later. That's the only way to trend trade the initial parts of these and add to it that I think works at all. If you try to buy in with 1 contract and hold it all the way through, your risk is stupid. It means this. It means that you got in here and you caught the impulse. And now this is leaning back and saying to you, 100% of your profits are at risk. Sure, you should get out of break even if you have a good winner. Don't take a loss. But essentially, you'll lose everything if this doesn't end up working. And that means this second leg it doesn't just risk, I mean, it has this opportunity risk, and it also emotionally will hijack you if you don't do this correctly. I really recommend that if you have a position that can't be divided up by taking profits and adding, you should just be a first leg impulse trader. You should not be looking for multi-leg moves if you only have a single contract on the table. That's just my opinion and my strong recommendation. Okay, so that's just what I think. Now, if you happen to pick up on this here, I think anyone who's familiar with this system and tracked all these events should have been pretty clear about what was going on right about here. This was open interest theft in elasticity. This is standard stuff. So we're moving up. Okay, so we got that to work. So you could see. So you might say, well, how did this, who did all this? Well, these monkeys right here, those jerks. They tried to get in and sell there, and then they got stuck and they tried to hold. And can I prove that? Well, yes. Look at right here. You see that acceleration? How do you accelerate tension? If I could hear you, I'd hear, you liquidate the counterparty. Is that what you guys yelled? You liquidate the counterparty. So what was this? Oh, these guys. 4 jerks got liquidated through about where their stops should be. They accelerated tension. We know what's going on here. The bears just got kicked in the teeth. In the teeth. So what's going to happen next? Well, the bulls have a pretty specific goal. Their goal is not to take over tension into the close during elasticity. If you have an elastic market, you don't want to do this. You could. Your goal is to disadvantage the controlling party as much as possible so that the next day, in this case Friday, you can hopefully pop tension up and get everything in your favor the next day. Get yourself a trend cap. And a trend cap, we had one right here. A trend cap is where you get both the 30 and the daily flipped over at the same time. And if you look at the internal components, usually it means you've just beaten down the controlling party, like one of their positions. And I think we beat this position down. The only difference here that I can see from when the bears beat down the bulls from yesterday is that the bears didn't show up. This wasn't like a big old bearish position. This at best was the shadow bears. Okay, so the shadow bear they don't have as much, they're still legitimate money. So don't forget that. They have bank accounts and they're big ones. But they're not as big as a legitimate liquidity. I mean, if we'd have seen tension right there after that, like curl down and said, and then go up, then we would have said, oh man, there's a legitimate like position there. That's intense. So this beat down, everything was here. It's not like it was illegitimate liquidity, but it beat down a position that didn't get picked up, I think, at all by bears. It was just shadow bears. It just immediately turned upside down. And the bulls, well, actually it was pretty similar yesterday. It's done. I mean, this is done. It's over. This was clear to me. The market was done at 12 o'clock. 12 o'clock Eastern, I knew what was going on. This right in here after that we picked up that liquidity. In my opinion, it was pretty clear we're headed up. And let me tell you where this is going. Can you see that? Oh, I drew over it. This is where the bulls want to get. Why? Because these little stinkers, who are just jerks, in my opinion, this is where their stops most likely are sitting because I didn't track any good liquidity through the highs. They're going to match up their stops with the place where that would make them wrong, and that's what would make them wrong. 313.75. That's where the bulls want to get this, and that's where it's headed as long as bears continue to do what bears do best, which is fill orders and make mistakes. That's their favorite thing to do. They rarely get moments to shine. Bulls just do so much better. I'm sorry. I know there's bears. I'm sorry. I just hate your team. Okay, so what's going to happen here is tomorrow the objective is clear, and I want you to sit up in your seat and note this. We had bears defend daily tension earlier, right? It was just like mind blown. The bears did nothing, and they get a little daily test, and they're like, no, wait. Crap, that daily test just played into the bull's hands. Oh, that's not really useful, is it? Bears can't seem to do anything right. So the bears defended daily tension. Tomorrow morning, I think we're going to see another. And I'm not sure that the bears are going to do anything about it. Why would they? They've just been... And they had control. So unless the bears step in here and do something, this elasticity has essentially broken the backs of the bears. They didn't get anything good yesterday. We're back to their position that they had yesterday. And all the bulls need is a little, hi, this is CNN, and today in the news, pigs fly, and the market will flip out. Whatever the algorithms are primed up to be sensitive to, or whatever the algos, so the algos have a value called fitness, if you've ever heard of this. When you're doing machine learning, you look for fitness. And all we have to do is take a look at the fitness function, which is a Gaussian function, usually. And it's an area thing, and it looks something like this. You'll see these, it looks like a map. You know how maps have like terrain things, and you'll look at it from above and it'll look like this? Something like that. And then from the side, it's a mountain. So what the Gaussian functions will do is they sort of just figure out how to calculate this spot here, the top of the mountain, and say that would be the most sensitive. And there's a set of words and dialogue in these algorithms. So we look at the Gaussian function, we optimize it and say, here's the keywords that are at the tops and optimized, and that's it. That's the whole thing. And then we just say those words. Pigs, Trump, airplanes. There were some pigs on an airplane that was flying over the Trump rally, and the algorithms all have seizures. We just got to meet the right grammatical and linguistical, maybe the whatever, and that's it. And these bears are going to be playing hot potato with their trade. Now, if you remember, this trade had everything to do with bulls had a really great case. I thought it was excellent. I thought they had everything they needed, and they just did nothing, like idiots. And the bears were just opportunists. They were like, oh, well, okay, we'll do this then. And then they took it down another bit. So that's where we're at. This trade here is about to eat dirt, push up daisies, you know what I mean? And this is where the bulls want it. So what is this going to look like tomorrow? I mean, come on, what do you think? Tomorrow, all we need to do is get some bulls here and see if we can get this up. We're going to have a moment here where daily tension likely pushes over. And you need to watch that, because that's the moment where your risk is the highest. Because if the bears decide, no, we're going to defend this, and they inject all their capital, you have to remember something really big here. You can't disrespect an institution. The reason that they're at the scale, the reason that I track them the way that I do, is because I'm looking to filter small accounts. My objective is to filter small accounts and unconnected traders. I want to know that these people had to communicate and manipulate the market to obtain that liquidity. I want to know that you had to make some phone calls to powerful people. I want to know that. I don't want to trade with losers. I want to trade with people who rub shoulders with market makers, with market operators, with the people who run the floor, even the new virtual floor. That's who these people are. They're connected, they're well connected, they're wealthy, they have huge accounts, they consume liquidity, they're interested in secrecy, they're massive, they vote on their positions. They don't just compulsively do it. These things take voting, they take planning, they take structure, they call the Federal Reserve. These are big, connected, powerful people. If you're trading with anyone else, it's because you're trading with the wrong people. That's at the end of the day, that's it. Markets are a device used by the wealthy, and they don't represent or give a crap about poor people at all. At all. Not the poor people, not small businesses, nobody. These care about one group and one group alone, the rich the powerful. And so that's who you should trade with. And I've done as much work as I can to try and filter so that all we are tracking are those people. All we care about is their little emotions. That's it. So I think that's what's happening. Tomorrow, these bulls have come in and they've got everything in place. They demeaned the bear. Here's what we need tomorrow morning. We need to see this pop up, and I think right here would be a great chance to track the bear, the bearish hand. And that pops up. Maybe it doesn't, I don't even think it would probably have to open that much higher. It could open flat. It could open a little lower and then move up. It doesn't really matter. As long as we get a little daily sample there, we're going to see what the bears want. Then we need the bullish position to get tested. So maybe velocity comes down, gives us a sample. Maybe decay rides down off the open and then up. And then I want to see the bulls come in with everything they got. Get those big bats. Because tomorrow morning, I think there's going to be an interest in likely gathering maybe some more bag holders. I think we already found them. These guys got wiped pretty much already. These guys, I think, are going to be the new bag holder. And the goal is just their stops. And just keep in mind that there's going to be some people out there, I don't know who, but they'll probably try and take advantage of the move that's set up in place right here. I don't know. They'll probably say things like, we're the ones who called this, and you should pay attention to us because we're the ones that called this whole thing, and it was our channels that you should watch because we really want to tell you the truth, and we really care about the world, and they want to tell you the truth. And then, okay, it's gonna, yeah, I think you get the idea. We're gonna have people who are gonna do something that I call credit claiming. I think this is what's coming up next. Are you ready? Credit claiming. Market pops, everyone scrambles to get the microphones out. There's the microphone. Here at the news, we called this move up because we told you all about the people who were rioting, and that's the cause. We are the credit. We take credit. We claim credit. So it's going to be credit claiming. I think that's what's coming up tomorrow. A bunch of credit claiming for a market structure that has taken like 3 days to develop. So tomorrow morning, what do you want to watch for? Let's just clear. I know I did a little venting here. You want to look for 1. This is going to be a thing. Keep your eye on this daily test. This is going to be a thing. They did come in and defend force, so your risk is going to be at its highest point when daily tension tests 0, because that's the moment where the largest institutional-sized bears will say whether they want to play or not. 2, we need bullish liquidity right off the open, and I think it'll be quick, it's going to be fast, and you get one shot. That's what I think's coming. So that's what you got to pay attention to tomorrow morning. The goal of those bulls will be to pump the market. The bulls want to see something like this, where it gaps up and then pump it all day. And to pump a market, you need a bag holder. That's how it works. So that's where we're at right now. That's what I think's going on. I think this is actually pretty structured stuff. I think the market, I'm going to get rid of these lines because I'm not as interested in them anymore. I'm going to hold on to those because those are the ones I drew out on Wednesday, and I think they still accurately represent what the market's looking at right now. So keep your eyes on this. If you're holding along and you're doing more than impulse trading, remember we're doing a little trailblazing here, and I just want to make sure that you guys make some money before you make a lot of money. You make sure you catch a little bit. Okay, that being said, I hope this was useful. Nate says the pit took it to the weekly midline, and that may be true. Maybe that assisted in the way that this functioned. I think there's a lot of, if you're an institutional player, I think you make decisions based off stupid things. And don't get me wrong. I think if you have $1 billion and you do a thing it looks like the thing you did is the cause of the win, but it was the $1 billion. Just like if you have a really good looking girl in junior high and she tells all the boys there's going to be a party with punch, and all the boys show up to the party and she says, my goodness, boys like punch. Oops, she messed up. She got really confused. She was a good looking girl talking to teenage boys who have no brains. And they all went for the punch. No, they went for the girl. And it's the same with institutions. They make these decisions and go, we did it because of the line. And you're like, no, it was the $10 billion in your trading account. And the line, I guess. And I also think there's a huge precedent for an institutional player to keep up status quo. If you break down status quo, the uncertainty level, we don't want traders realizing that markets are not random. We also don't want them thinking that they are completely random, because complete randomness means there's no actual opportunity to do more than just mindless algorithmic trading. So if we could get people to believe that they're sort of random, but they're definitely not random, then you get people in this area where that they're comfortable with continuously losing money until they've lost it all. You can't tell people that it's totally random. Then they'll go, well, I don't want to play. Okay, well, it's a little less than random. They go, oh, okay, well, that means there's an edge. Yes, edges. Look for edges. And the truth is, I don't think it's actually random at all. I think randomness is a function that's just pumped into the fact that we collide with orders. Therefore, randomness is a feature you really only deal with on a tick chart or low, down low, lower. In terms of day-to-day activity, I don't think it's random at all. I really don't. We do this all the time, and these things play out in a very clean and structured way according to rich people, rich, wealthy accounts. So I don't think it's not like I'm not saying don't track things that are important to institutions, but and you're saying that he totally agrees, and I'm saying for everyone else, just remember that the cause of their success is not the things they're doing, it's the money. The pretty girl is why the boys came, not the punch. Even though the pretty girl's saying, punch brings all the boys to the yard. It's not the punch. It was the girl. She's just deluding herself about the punch because people do that. So I think that institutional people trade for stupid reasons. But because they're institutions, those reasons become not stupid. And the big mistake is when traders get too hung up on the stupid idea and not hung up enough on why the institutions are playing and what they're really doing. And so I think they're okay to track, but only insofar as that you're tracking institutional behavior, not something to base a statistical model and try and auto trade. But that's just my opinion. And I know a lot of people have a different opinion. You might want to auto trade things, or just, when I say auto trade, I mean stop loss, take profit, hop in, turn your brain off, wait for the profit target or the stop to get hit. For me, that's auto trading, whether it was a computer that did it or you. If you have no idea why you won or why you lost, you're auto trading. So I don't like that, but if it works for some people, it works for you. If your account balance looks like this, keep doing it. Miguel, so I like dark pool prints, I do. But they have this really irritating problem in that on indexes, they're always late. They're after the fact. They miss the point. Inherently. I already saw that the bulls came in. I don't need dark pool prints to come in and tell me, and a bunch of institutions bought in at 302.75. I already know they did. So I won't know that until tomorrow if I track the dark pools. Now, it's not that dark pools aren't useful, but they're built so that you cannot use them intraday. You cannot, because of the way they work. You can't know if the dark pool got in and got out until it's over. And so I think they're useful for longer term analysis. But for this, the way that I track it, I'm like, I see what they're doing and I see where they're at. telling me that they got in tomorrow is not going to help me. I do think they're a little bit more useful on other things. I think the indexes are built sufficiently to conceal institutional orders because they can go from stock to index to future to options down to future to indexed to index futures down to equal index, and their options, they can hide in so many places. It's stupid. So I don't think dark pools, in my opinion, are as important as some people say they are for the indexes because institutions can easily hide all over the place already. But I think when it comes to things like oil, soybeans, or things that aren't built out of these highly complicated places where you could hide in any nook and cranny, or if you're looking at just a stock in specific or an important stock in the market, it's a little harder to hide if you're going to go in and buy Amazon, because it's hard to buy an equivalent to Amazon. It's also hard to hide in Amazon. But with an index, you can do all sorts of things and hide. So I think that they're more important on auxiliary markets or other markets, not this particular setup that I'm using. So I do think they're useful. Just for me, they're late when it comes to index trading with futures and stuff. They're late all the time. I like them, but I just wish they would show up, on time, not after the fact. When it comes to the dicks, as in squeeze metrics, everybody loves squeeze metrics. I don't know what to tell you. I mean, people seem to like it. So I encourage you to go use it. He seems like a guy who's got the right kind of stuff. It looks like a good tool. But so those are my opinions about those two things. Okay, so can you talk a little bit about switching from analysis to risk trading? How do you make the switch? What is the trigger inside you from analysis to trust? Does the inner dialogue change for you? Okay, first I'll answer, does the inner dialogue change? Absolutely, yes. My dialogue goes from like when I'm looking at events that happen, like this morning, you're sitting here and you're going, okay, here's this, and it pops up. What I'm sitting here thinking is, oh, okay, and I'm in the discovery process. I think it's an I. Discovery process. I'm discovering, basically if the players are holding a hand of cards, I'm peeking over their cards and trying to discover what they're doing. And so basically I'm operating from a void. I have a void and I'm taking in data and I'm trying to populate that void with some version of reality that is stringed along. So I'm sort of going, okay, here's the bulls. Do I buy this? No, I don't trade when I don't know what's going on. Bears come in. They fail. Okay, in terms of this, I'm going, all right, so I see what they're doing. They're going to fail. And so I'm sort of taking data in. That's the dialogue, taking data in. Okay, so the Bears they did this, they did that. I'm putting the story together. I'm matching it up with yesterday. I'm trying to piece it all together. It's a very difficult process for a computer. I think humans do it quite well because we're very built for narrative and stories. We love our stories. You don't tell stories, it's because you're lying to yourself. You do tell stories. We all do. Then once you see this event happen, like about here, I start saying things like, okay, they didn't come in. I start building the expectation, which is still part of the discovery process. I expect the bulls to get tested. It moves down, we get a risk reduction. I'm like, I really like to trade with liquidity. Then we get liquidity. And I say, wow, I'm getting everything I want. And once you get everything you want, there is always, every single time, a moment of clarity. And I want to make this really clear. Clarity is not certainty. I think there's an I in there. It's not certainty. It's not. You never get to say, I know. You get to say, I know this, I know that, but you never get to say, I know this trade will work. Ever. In fact, you should never. And for me, this is the kind of thing I sort of emotionally look for when I'm looking to execute a trade. Now, I do care about risk reduction. in terms of I don't want to take on all the risk. Are you crazy? I want my objective here is to try to trade with. I am not an influential trader. I don't have a bunch of money. So my goal is to trade with an institution. I'm trading with them in their clarity, in their certainty. I'm with you. And that's my goal. I want to see that they're here, and then I'll hop in as best as I can. And the way that you get your order as close to their position as possible is expectations. If you don't expect that to set up correctly, then by the time you figure out what's happening and then you want to execute an order, you're not going to be able to get into this low. You're going to have to wait. You're going to get a worse price. It means your risk is higher. But if you expect it and you're like, oh my gosh, everything's lining up, then when you see it developing, you're just itching to fill an order because you know exactly what's going on. And then when you fill it, I love this. It was just instant green. Instant. There was I never saw a red at all. And that is what I love. Your expectations get met, and you get everything you want. And then it lines up, the clouds part, you go, oh my gosh, it's perfect. And you're antsy about filling an order because you know what's going on. Well, you feel you know what's going on. Nobody ever really knows, but it works pretty good. That's how you get into the position, is that you expected it so much that when it happens, it's almost like certainty, but really it's clarity. And they're not the same. You can never and should never have certainty. You should never say it's certain, or your emotions are screwing with you. So once you get into your position and it moves a little positive, okay, this is a really big point here. You're shifting. So what he was talking about is you're in analysis mode here. And then once you're in your position, you move into trust. And this is a big deal because this is where everybody dies. Everybody tries to live here. They want to say analysis, 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 analysis. Because analysis comes with the stigma of smarts. There's this big, I can virtue signal with it. So people will try to dump a lot of analysis at you, and they'll throw things because of the smart feature. But then they run into a struggle, which is when they should be moving to the trust, where that you drop analysis, they keep saying analysis because they're carrying risk, and their fear drives them to virtue signal, and it will kill you. Why do you virtue signal? Because that's seen as it pads you from the pain of risk. So people will virtue signal. Okay, so what is trust? And so you're all familiar with this section. What is this trust section? If you're not familiar with this, I'll go over it. Trust is where that you don't spend your time as an entity discovering the market. Trust is something that only human beings can really do with each other when it comes to growth. Animals can trust each other in terms of me not kill you, but that's not really trust, that's friendship. Friend versus foe. A friend doesn't mean you harm. Trust is about growth. Trust means we work together to increase society. Trust, we work together to increase society. In the end, equity is trust. It is. They are not two different things. They're not abstractly related. There's not a correlation or a causation. They are the same thing. When you get to a point where that you're asked to get into a position, you start dealing with equity, which is trust. You're trusting the institution to act like a rational human being. But more than that, you're trusting the past version of yourself to be an intelligent person. At this moment, the dialogue in my head becomes, so we went from what do I expect through here, do I, to what did I? I'll make that big. What did I expect? When you get in here, you think, well, I expect the bulls to push the market up and sample the bears. I expect the bears to get sampled. And we sat and tinkered with that forever. The bulls wanted maybe another position and the market tried to lean down, but it never really got there. What did I expect? Well, at that moment, I thought, okay, I want to liquidate these guys. I want to sample the bears and see if they're done. I also want to pump tension as high as possible. So I started saying to myself, what did I expect? And I stopped injecting my own opinions. I stopped. I took the state of myself and I trusted that I am an intelligent human being who understands markets. And I trusted that version of myself with my eyes basically closed in memory. And then I tracked all the events here. Okay, this is moving up. We're almost getting bears. Okay, if the bears come in, what did I expect? Well, I wanted to see these guys get liquidated, so I'm constantly referring to myself, the past me, constantly. And as long as this market essentially meets this version of myself's expectations, then as I track the events, things like bears getting sampled here, things like the market leaning down and almost sampling these bulls a little bit, things like it getting close to but not ever quite giving bears a sample. I'm tracking all these events in real time and taking them seriously, but comparing them to my past self. There is one bias I impose, and that bias is I am biased to believing this guy is right. That's my bias. I put it in and I say, you know what? I'm a smart individual who has tracked this for years. I followed this along. I know what's going on. I know who's here. I am biased towards me. And let me tell you right now, anyone listening, never bias your trading position based on the credibility of another human being. You're doing it wrong. You should never buy because I said to. You should never hold because I said to buy. You should bias it based on you. You can't really take risk making me liable for your screw-ups. Because then if you lose, you just say it was my fault. So you never really took any risk. It's about you. You need to say, I believe in myself so much that I'm the one who matters here. I'm the one to listen to, not you, and you need to get there. I do these to teach you how I got there. And I think I'm there. Sure, maybe I'm wrong. I like to think I'm there. I do. And I say, come, do what I'm doing. Here's how I'm doing it. Come along. Learn to trust yourself in a way that's not overconfidence, in the way that's actual equity. Trust is equity. Overconfidence is loss. So in this instance, how do I tolerate a range like this? It did nothing to betray the opinion of the person I hold most dear, my own. And that's how it worked. I want you guys to do that. I love it when I get into the Discord and people go, this just happened. And I'm like, that's what I think. It's not because I said it. It's because they see it. And they're right in their own accord. I love that because it means that I have smarter people around me. The best people in your life are the ones around you, not the ones you haven't met or found. The best traders that you know are the ones around you, not some douchebag on the other side of a paywall. The best people in your life are already there. Develop them. So I'm trying to do that. I trust that you people are great, that you people are smart, just like me. That's why you're here. And that you can become diamonds, smart, intelligent people with opinions that are diverse that I can benefit from. There's way more value in creating growth than running around looking for somebody with the smart idea. Screw them. You're here. You're smart. I'll develop you. And if you think I'm wrong, develop me. And we will get better at this together. We all win when we all win. We got to grow together. It's just how it works. So I got something good. I'm trying to make you smart so that you can have it for yourself, so that you can be useful. And if you disagree with that, just get out of here. I don't want you listening to me anymore. I want you to be as good as me. I want you to do what I do, not to follow me. There's a time where you have to follow in terms of learning, but then you should go do it yourself. as much as you can. Share. Stop being secretive about your secret tools. Share. Teach. Listen. Learn. Consider. Think. Be open-minded. And then when we sit down to the table together, because we all do this, we're all in this together, we can all benefit from each other. And I'm convinced that you guys are the best that there is. Even if I don't know who you are. If you're here and you can hear me, I'm convinced that I can convert at least half of you into useful traders. I really am. And so the payout for me is that I get smart people. That's a huge payout. And I don't even have to pay for you guys. I don't have to pay you $100 a month or something to access you. You're smart and you're around me and I get your contributions. I'm benefiting greatly. And if you think that's a silly business model, it's because it is. It's totally contrary to what most people are doing these days. Most people are looking for the diamond to sell it. I'm not looking for that. I'm looking for the crap that is you to turn you into what you want to be anyway, which is better at trading. And I hope you can get behind that. I really do. So when it comes to this type of trust, you have to understand there's a whole mentality behind it. Trust and equity are the same. Think of what would happen if you lost trust in your bank. Think of what would happen if you stopped thinking that a dollar was worth $1. You were concerned that it was going to be worth nothing tomorrow. Consider what would happen if you were, like we're seeing now, lost the trust that your family could be safe going downtown. The value of society is all based on the amount of trust. And in this market, you can use trust to your advantage. And I think institutions do it and they know they do it. They trust each other to act in a way that benefits them. And so in some way you could say that I'm a herd trader because I trust the group that I participate with. But you have to trust the right group. When it comes to the masses, the ones who have low bank accounts, high volume, they're the wrong group to participate with. It's the ones with the high volume or high bank accounts, low volume. That's the herd to look for. And those are the ones I trust. And I think I'm smart enough. So when I switch into like that mentality here where I say things like you have to trust yourself, it's because all these new data points are not being fed to you to tell you stories about what's going on. They're being fed to you to tell you about the credibility and the durability and the expectation of this position here, these traders. And so we see them get liquidated. You don't say, woohoo, that was so surprising. You say, okay, that's what I was looking for. Now, if they got liquidated, what do these bulls want next? You should never do an about face and start looking at the past. You should never say, well, now that we're here, then no, you should say, okay, all the things I was looking for, let's take a look. I'm leaving these lines on my charts because they were things that I thought was important. And I'll continue to track them while they play out. I'll continue to observe this. And once the market starts betraying the version of me that got me into a trade, then I'll start to move back into discovery mode. Until that happens, I will continue to believe that I'm trustworthy, that I'm credible, and I know what I'm doing. And I think that's the way this is done. In any market, in any area of your life, you never really know. But you can believe in yourself, and you can trust yourself, and you have to earn that trust. I didn't just choose to trust myself. Trust is like a subconscious thing almost, where that you believe the thing you're trusting is real. It took time. It took evidence. Evidence being profits over many iterations. You have to feel like you anticipate things before they happen, and you're right. You have to have expectations that happen. You can't just say, well, hindsight's 20/20, I guess I was right. That's not how you build trust. You build trust by taking risks on yourself and seeing those risks pay out time and time again. Then you'll say, I'm real. And when you do that, you won't need me anymore. When you do that, you should go teach your friends. Go find other traders and say, hey, I found a way to make this happen, and show them. Because if you're not doing that, you're not growing our economy. You're a bear. bulls are, in my opinion, they're people who go out and they share, they grow. Maybe that's an ideological bull crap that I just subscribe to because I don't know, I have kids. But that's growth. That's economic growth, is trust with each other. If we could stop squabbling and worrying about this, we can trust each other. That's real growth. And I think that we should all do it, and I think it will help. I feel like I'm plugging for like a activist group or something, but I'm not. Everyone in here has heard me vent about this before. Okay, Edmundo, I want to say Edmundo or Edmundo. Edmundo says, even big institutions must take profit at some point, surely. Or can you see even, okay, so let's talk about institutional profit taking for a second. I'm make this brief. This video is getting a little long. Institutions don't take profits the way that you do. We exit a position, stick our hands in the air and say, woohoo! Institutions get footing. And one thing that I think that institutions do that I don't necessarily do, mostly because I can't afford to, I don't have enough money, is they never exit the market. They get in a profitable position more and more and more and more and more. And so if you're looking for a place where the institutions exit, let me show you what it looks like. The bulls might come into the market. It looks like this, and then they cover. This is what institutional profit taking looks like. Not like this. When the money gets transferred out, the price gets set in stone. There's no money to move things anymore. The grease is all gone in the gears. When institutions dump, it goes sideways. And I want to show you something really interesting. Institutions trade, and then when they get out, things go sideways. Uh-oh. That's just what it looks like. When you pull all that money out on an index level, things stop moving. They don't reverse. That's important. So when they get out, exit their position and maybe look to resell. So maybe if there were sellers here, they covered and they want to resell, this is what it would look like. Typically, I think institutions, they buy in, it moves, they hedge. Buy in, hedge. Buy in, hedge. Buy in, hedge. And it gets more aggressive because each time you hedge, you have to cover. So if you bought with one, you hedge with one. That's a sell. That sell, you cover with one. And you buy with one. That's two buys. Now you have a position of two. Because the one buy was covering the hedge, the other buy, so you have a position of two. So the next hedge is two. That means you have to cover those two, plus buy in with two. That's four. All of a sudden you can understand the parabola, right? Every time you hedge and you add, your position gets bigger and bigger, and your impact causes a parabola. Parabolas are unsustainable. At some point, they blow out, and that's when you cover. And that's how I think institutions essentially operate. And that they don't really get out of the market. They just move those profitable positions into different things. And that's what I think they do. So when you're looking for profit taking in terms of institutions, be careful, because I don't actually think that they necessarily exit the market the way that you might. It could be that I get a profitable position and I take some profits out of it, and I essentially transfer those profitable trades into maybe a hedge fund or a mutual fund, and I show that that mutual fund now has higher profitability, and it sort of makes that mutual fund a little bit better, and I never really let go of the positions, and they start doing little shady things in the background. I think the profit taking is a little less clear than the entries when it comes to institutions. And that's my opinion. So I don't have a lot of hard evidence for that. But in the time that I've spent pondering and meditating about markets over years, my conclusion is that institutions do not exit the market the way that we do. Their objective is not catching the delta, the difference in price over time. So that's one of the things that's sort of tough. But you need to make sure you take profits. And that's, I think, one of the things that catches a lot of people is that you're waiting for similar events to come in to tell you when to cover and stuff. And they're not the same. And so I think that you just sort of have to recognize when you got into a trade, recognize when it worked, recognize when it went well, and say, I'm done. And be happy. I say that's a phrase I say a lot, and I say it to myself on purpose. I'm going to be happy. I take the money and be happy. It's like you're not happy until you exit. I don't know. That's just what happens to me. Okay, so you anticipate, somebody asks, how do you anticipate institutional stops? So institutional stops don't work the same as your stops. They unwind a position because their positions get all over the place with insurance and rules and blah, 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 and they're everywhere. So they have to unwind. And the only way to get an institution to unwind a position is to make them wrong. You can't push them out. You have to say you're wrong. Once an institution says, oh, okay, we're wrong, they fold. And that folding is unwinding, and you see that in tension. So let's see. If these guys right here were wrong, the question is, what would make this institution wrong? Well, I think if the market opened here tomorrow and then tension pumped down, and clearly the bears showed up and price was here and it pushed down, they would say, oh crap, we're wrong. We're not getting this where we wanted. And it would push down. And somewhere in this area down here, there would be a place where that essentially how wrong you are. So I'm going to draw a graph. Wrong. And this one would be need. Let's see, need out. I guess that's demand. You're going to get like this, where that how wrong you are runs into how much you need out at a certain point, and eventually it becomes asymptotic. And that's how that they get out. So you would look at this area and say, well, here's a pivot here. There were some bears here. Well, if those bears are getting paid, basically, you know, if we got to the low of this day, I'd be burnt as a bull. We wouldn't even have to get there. If we got this position positive, that's what would bug me. And that's when my risk tolerance would shoot straight up. I'd need out, and I would be wrong. And those two things have to be true. So I will eyeball where to put their stops. So how did I come up with this, having stops here? I just looked at it. And that's really the best way in my experience to do it. You see it happen, you go, where would they put stops? Where would they be wrong? Here, look at that. Double top kind of, sure, right there. And it's not always the same. Sometimes it's different spots. But what you should do is just glance at it. Right there. And usually the first response is typically pretty good. Don't spend a ton of time looking at it. If you've been keeping up with the market, you probably have a pretty good sense of what would make them wrong. So I anticipate them, that's how I build that stop loss area. How do I anticipate that they're going to get hit? That's based on the structure, looking at tension, the fact that bulls were able to come in, we had elasticity, the bears were getting pushed and they were upside down, and I'm familiar with how these people play the game. And so I had expectations that were being met, and I anticipated, which is different than expected, I anticipate that those positions would get liquidated. And the anticipation comes in the form of I'm in trust mode. Expectation mode means I'm continually building expectations. Trust mode is where that you're sitting there going, past me wanted this, and so I'm anticipating that past me is going to get it. And so the way you put that together, it's all structure and data points and things. So figuring that they'll get hit is different than figuring out where they'll unwind. Hopefully that helps. And keep watching these, every day I'll go over how I put those together each time I do it, so that you can get familiar with how I do it. And then you should come up with either see if that works for you, or maybe you have a better way to do it. I'm all ears. That's the way I do it. It seems a little abstract, but I do think it's actually pretty consistent. So question me the next time I do it. Why'd you choose that? Go ahead, grill me. I try not to say things that I haven't thought through, because this matters a lot to me. So I try to say the things that I can back up. And if I say something that I can't back up, you guys should be grilling me about it and saying, why'd you say that? In which case I'll reflect on it and say, oh my gosh, I shouldn't have said that. And we need that. Don't just trust me. Okay. So I think that's all the questions. This video's gotten a little longer than I expected. I hope it helps. Pop into the Discord. There are links down below this little video with the Discord and stuff, the Zoom and all those things, the tools that I've tried to put up and make available to help you guys learn and become useful to me. Sorry, I think it's funny. I'll see you guys tomorrow.